The reason most traders get stopped out is because they only trade one time frame. Have you ever taken a trade like this? Your stop loss gets hit, and then the market moves exactly where you predicted. Before looking for an entry, professional traders always start with the higher time frame. Here we are looking at XAUUSD on the 4-hour chart. At first, price was moving in a strong bullish trend, pushing to a major high near the top of the chart. But after that peak, the market started to shift. We can see a strong rejection followed by aggressive selling pressure. Now price is forming lower highs and lower lows, which tells us the short-term structure is beginning to turn bearish. This higher time frame analysis gives us context. Instead of randomly entering trades, we now understand the direction of the market. And once we know the direction, the next step is to find key levels where price may react. Now that we understand the higher time frame structure, the next step is to mark key levels. Professional traders always identify where liquidity is likely to sit. In this case, we can clearly see a major resistance zone around the recent highs. This is where buyers previously pushed price up and where many stop losses are now located. Below the market, we also have a strong support level, which has acted as a reaction point in the past. These levels become our decision zones. Instead of trading randomly, we wait for price to come back to these areas and then look for confirmation on a lower time frame. After marking our key level, we do nothing. Professional traders don't chase price. Instead, we wait patiently for the market to come back to our zone. Here we can see price pulling back toward the resistance area. This is where liquidity is likely sitting and where the market may react. But we still don't enter yet. The next step is to move to a lower time frame to look for confirmation. Now we move to the lower time frame. This is the 15-minute chart of XAUUSD. Here we can clearly see the market structure. Prices forming lower highs and lower lows, which confirms the bearish pressure. When price pulls back into this area, we start watching for an entry opportunity, but we still need confirmation. Professional traders wait for a break of structure before entering the trade. Price forms a lower high, confirming that sellers are still in control. After the pullback into resistance, the market breaks structure to the downside. This is our entry signal. We enter the trade here, with the stop loss placed above the lower high. From this point, the selling pressure continues, and price moves in our favor. After the confirmation, we execute the trade. The entry is placed right after the bearish break. Our stop loss goes above the recent structure high, protecting us if the market reverses. And the target is set at the next liquidity zone below. This gives us a clean risk-to-reward trade, where one good setup can cover multiple small losses. Price moves exactly as expected. The higher time frame gave us direction. The lower time frame gave us precision. And this is the power of multi-time frame analysis. One clear plan, one clean entry, one high probability trade. If you want to master trading strategies like this, follow the channel and visit fundedcapitalhub.com.